Hello and welcome to Investing Confidential, where we will give you insights that you're not going to hear from the talking heads on television or even the internet. Today, we're going to talk about real estate and the declining real estate market. There's a lot of videos out there, but I'm going to give you something that nobody's talking about, and really, it's the reason why the real estate is crashing and is going to continue to crash, and why really it was driven higher. And it certainly had very little to do what most people are talking about. So let's begin. But first, please subscribe if you like this video, and hopefully, I know we're new, but hopefully we'll add some value to you, and you'll enjoy what you hear. So let's talk first. Okay, look, everyone's talking about real estate. The prices are coming down, except if you're in Miami or New York, but even that's turning now. But everyone's just focused on one thing, and that's interest rates, right? So it's easy to say, oh, mortgage rates are at 6%, 6.5%, and that's why real estate's coming down. Look, I don't disagree with that, but mortgage rates are just a reaction of obviously what's going on in the economy and what's going on with the Fed. And at the end of the day, it's just the catalyst that popped the bubble. And the bubble had nothing to do with low interest rates. Okay, nothing to do with low interest rates. Prices went up for other reasons. So to say that the reason that real estate is dropping, both the single family home market and the rental market, has little to do with the mortgage rates. Sure, it's something that's important. It was the catalyst, but there's something even bigger out there that no one is talking about. Again, you could see from these charts the veracity of what has happened to mortgage rates. You know, it is what it is, but certainly it's something that has led to a lot of things that people are talking about. Okay, look, home listings are up dramatically. That's obvious, right? Everyone's trying to sell. There's no buyers. Home listings are up. We talk about home supply is rising rapidly and will continue to rise rapidly. Again, a result of what I'm going to talk about in a minute. And now also you have new homes under construction, again, hitting 10, 20-year highs. Home builders had a lot of capital. They had they were able to raise a lot of money. They were able to borrow a lot of money, and they're just trying to meet supply. They had some issues with lumber price and other things, but that's all gone now. And these home builders that just have to build homes, and they have to use this financing that they've acquired over the last few years, and they're just going to add to what is already a declining market. So let's go into the real reason why real estate is coming down. But first, we have to go back and discuss why real estate went up. And it had very little to do with declining interest rates. Yes, very little to do with declining interest rates. The reason real estate's been rising since the financial crisis, and especially over the last few years, is one reason. We've had one institution which started this whole boom, and then everyone jumped into the pool, and they're doing the same thing. And that institution was Blackstone. Blackstone has been buying thousands upon thousands of single-family homes for the last 12 years, every month, sight unseen. Okay? They have taken advantage of declining rates. They've taken advantage of the fact that they're shifting demographics, meaning younger demographics. And I'll show at the end of this video some of the real staggering demographics that are really going to hurt real estate long term. But they've been taking advantage. They're buying homes, depressed homes, which they started doing right after the financial crisis, and they continue to do. So they're buying homes and renting, and this was phenomenal, right? So they kept taking the supply out of the market and buying homes and renting, and it's been a great business for them. But so what happened? They've been very successful. So what happens? Everyone starts to follow, and the formula is very simple. You buy a home, obviously not in New York, but you buy a home, let's say in Phoenix or in Austin or in North Carolina. You buy the home for, let's say, $300,000-400,000. You rent it out. You get a rental yield of 3-4%. But since you're leveraged, right? So these guys can borrow, 20 times their capital, not like us, which we can't borrow 20 times our capital. They can leverage themselves. They can take $100 million and buy almost $1 billion worth of housings, get a 3-4% yield, but the yield back to them, the return on their investment capital is very high. All the return to their investors in the double-digit range, 15-20%. They've been doing that for years. People have been benefiting. But what has that caused? That has caused a major problem with real estate supply, especially in the middle to low end, where, the American dream, right? Supposedly the American dream. Since they've been successful, a lot of people have piggybacked them. Hedge funds, other large investment funds, and then you have a bunch of public companies. Companies like Zillow, companies like Open Door, they took advantage of this opportunity before the pandemic, and then right after the pandemic, raised a ton of money and just started buying thousands of single-family homes, sight unseen, every month. Imagine you have hedge funds, Blackstone, Open Door Technology, Zillow, about 10 other public companies, literally each buying thousands of homes every month. Okay? That's the reason why you who are listening to this, if you've been priced out of the real estate market, that's why. It has nothing to do with the John Q. Public or someone down the road taking advantage of a 30-year mortgage of 2% buying a home. Hogwash. The supply was taken off the market by large institutions taking advantage of demographic changes, taking advantage of very low interest rates, buying and selling and renting, buying and renting, building and renting, taking advantage of the consumer and taking supplies off the market, artificially driving real estate prices higher. And yes, real estate prices were driven higher artificially by these institutions, not by individuals taking advantage of low interest rates. Okay, that happened. The game is over. Okay, it is absolutely over. And I'm going to tell you why in a second. But first, I want to show you that I'm not just jumping on the bandwagon. Here's a LinkedIn post almost a year ago where I cited this phenomenon a year ago, saying the real estate market's going to collapse. And these are the reasons why. It has nothing to do with low interest rates. And again, pointing out the fact that these institutions were the ones that caused this major real estate bubble, and it is a major real estate bubble, and we're seeing the effects of it now. So what's happening now, because of this issue that's been going on, is we've reached a peak of the market, right? So these institutions, they can't buy anymore; they're tapped out. And one of the reasons I know they're tapped out, well, look, here it is, very simple. 2 timelines. Blackstone, almost a year and a half ago, they purchased a large real estate company. They just took advantage and they say, hey, we're going to put billions into this. A year later, a year and a half later, here's what's happening. They're no longer buying homes. If you peel the onion and read the article, as opposed to looking at this headline where it says Blackstone is not buying any more homes, not only are not buying any more homes, they're selling homes. Okay? In this American home subsidiary, they are selling. They're trying to get out of this market as fast as possible. They're discounting. They're taking losses left and right. The same with Open Door. Open Door, to me, is the canary in the coal mine. They've been doing this for years. They're buying 2,000 to 3,000 homes a month, renting them out, flipping them. It was a big old party. The party's been over for at least a year with Open Door, or at least a year, 8 months. They can't get rid of these homes fast enough. They're taking losses. They're selling out of their portfolio. And look at the stock price from 28. Now it's less than 4. Unfortunately, the future is not very bright for Open Door Technologies. Then you take Zillow, for example. Zillow a few years ago did the same thing. They took advantage of the pandemic. They borrowed a lot of money. They did a big $1 billion stock offering. And what did they do? They just went on a buying spree, sight unseen, using Google Maps, buying thousands of homes per month. What happened? 9 months later, they puked it all out. They took massive losses and puked it all out. That's the bottom line. So Zillow, that puke, which would happen late last year, was definitely the beginning of the end for the real estate market. But nobody's paying attention because everyone's listening to the real estate brokers telling you that there's no supply and that prices are going to go up forever. Ridiculous. Absolutely ridiculous. This is a classic, what I call beanie baby syndrome. right? If you remember what Beanie Babies were, if you don't, look it up on the internet. But the Beanie Baby syndrome was essentially this guy created Beanie Babies and realized that if he created an artificial issue that there weren't enough Beanie Babies out there, or there's going to be a certain number and then they won't make any more, people are going to have a feeding frenzy. This is exactly what has happened in the real estate market, in both single family homes for sale and also the rental market. And right now we're seeing both implode, okay? Because again, this was an artificial market driven by large institutions with a lot of easy money trying to take advantage of a market on a leverage basis. And now, the chickens are coming home to roost, and we're seeing a puke. And we're just beginning the puke. And it's gonna take a little bit of time, but the puke's gonna happen. Why? Individuals, institutions, they're very quick to raise prices in real estate. But when it comes to selling at a loss, they're very slow. So this is not going to be a 6-month phenomenon. This could be a 2 to 3 year phenomenon as prices continue to drive lower. Again, because the main buyer of real estate was not individuals, it was institutions, and they are no longer buying. So you had all these institutions buying thousands of homes. They're not buying any homes anymore. Okay, zero. So what happens when you have a market that was heated artificially, going from thousands of homes, maybe 10,000 a month, to zero? Significant. This market is crashing and nobody even realizes it. And you people sitting in Miami, New York, Los Angeles, San Francisco, you think you're immune? No, you're not immune. Already we're seeing prices come off in the Hamptons, New York, parts of Florida. It's going to happen, and it's happening already. So within 3 to 6 months, the entire country is going to be feeling the pain, including places like Nantucket, including places like Martha's Vineyard, including places like the Hamptons, Los Angeles, Beverly Hills. No one's going to be immune. Greenwich, Connecticut, nobody's immune. You're all going to feel the pain. And this pain is going to go over to the entire economy, right? So the houses are normally people's number one investment. And when those prices start to go down, people get depressed. And this is something that happens all over the world. So what's gonna hurt? Consumer confidence is dropping already, and it's going to drop through the floor. And what's that going to do? That's just going to feed on this whole recession issue. And it's not an issue. It's happening. Recession is here. And the real estate market having its issues is just going to accelerate this whole recession issue. And so that it's going to feed into the entire economy. That's the bottom line. So the prospects are really not that good. But let me be a little more negative and just go into why, again, the origins of this real estate bubble were demographic, and why the demographic issues are really going to cause major problems for real estate going forward. It's very simple. Look at this chart. The number of households, the number of marriages is just falling down, right? So years ago, kids were getting married in their 20s, forming new household formations, buying homes, buying cars, etc. Well, younger people are not getting married early anymore. They're not getting married in even their low 30s. They're getting married in their mid 30s, and some of them don't even get married anymore. So there's less less household formations, which means less demand for real estate. So the long-term prospects for single-family homes is not good. And the one pushback, well, what about inflation? Inflation is good for housing. Well, not really. If you look at the 70s, the last time this country went into a major inflation spiral, the 70s inflation caused, the late 70s and early 80s, a massive depression in real estate prices. The last time you could buy real estate dirt cheap in New York was in the late 70s, early 80s. Period. That followed almost 7 to 10 years of high inflation, created a massive crash in New York real estate. And real estate across the country, but especially in New York City. So people that say inflation is good for real estate, it's ridiculous. Inflation is terrible. Stagflation is terrible. And we're going to see the same situation happen today. So interest rates have been the catalyst, but the real origins of this is what we just spoke about. Okay, the origins of the real estate market had very little to do with interest rates and more to do with institutions taking leverage, taking advantage of demographic shifts, and just bastardizing an investment opportunity, driving out the American dream to a certain extent. I hate to be corny about it, but that's basically what had happened. So what's going to happen? Like I said, it's going to take 3 to 6 months for this to really go countrywide, meaning as far as the leaving the luxury real estate feeling the pain. But it's going to take 2 or 3 years because people are not going to take housing prices lower right away. They're going to do it slowly. It's going to be a slow death. The one market you want to watch for a bottom, if there is going to be a bottom, years to come, but at least it is the canary in the coal mine, is Austin, Texas. It was the hottest real estate market before the pandemic, and then it became the number one real estate market during the pandemic. Everyone from California moving to Austin, etc. I mean, you had open houses where you had 30 people online, 15 bids. Now you got open houses with one person online and no bids for months. That's the reality. Austin real estate is dead. Okay? Plain and simple. Phoenix, North Carolina, you name it, they're all dying, these markets, because the buyers have run away. And not the individual buyers, but the institutional buyers are gone. They're no longer buying thousands of homes, and this is the result. And so the result obviously is nothing, zero. Some prices are just going to keep going lower. Is there any silver lining? Obviously, there's a silver lining. So if you have been priced out of the real estate market, if you're listening to this video today, have patience. Okay, keep renting. That's another thing I want to talk about, the rental market. Oh, you read in the paper how there's no rentals and the rental prices are going up. That's another hogwash, beanie baby situation. There are plenty of rentals. If you go to San Francisco today, there are buildings with a lot of empty apartments. Okay, landlords purposely keep apartments empty to keep prices higher. But that's no longer happening now. If you go to San Francisco, that situation, they're starting to fill those because there's no one out there anymore. There's no multiple bidders. So they're trying to fill it. The same was happened in New York, where you hear people saying, New York is back, New York is back. Everyone's going there renting. Yeah, you got a bunch of young people renting apartments downtown. But go in Midtown, try to rent an apartment. There's plenty of apartments. Plenty of apartments. And again, these buildings held back, they keep apartments empty just to keep the prices high. But now that the incidental renter is starting to go away, there's not many people moving back to New York, more people leaving, these empty apartments are going to come back again. So even the real estate market, even the rental market in New York is going to be soft. And by the way, it's soft all over, and getting it softer. The bottom line is this: if you have patience, keep renting. In a couple of years, you're going to get really good price, a good value on the home of your dreams. Okay, that's a reality I think is going to happen for most people. That's the positive thing. The other positive thing is, unlike the 2008 housing crisis, which killed the little guy, the people that take it on the chin are the big guys. These institutional investors, they're going to take it on the chin. Trust me. The big banks, the money center banks, the city banks, JP Morgan, they have very little exposure to this crash. They have been very, very tough in their lending. They've been holding to very high FICO scores. Their exposure to the mortgage market and single-family homes is relatively low to the past. Who's going to take it on the chin? The alternative lenders. There's been a lot of alternative lenders, online lenders, alternative lenders. They're out there in the market financing all this crazy stuff. They're going to take it on the chin when we hit this recession. But the big banks will be good. A good place to invest. Again, if you've been priced out of a home, you're going to have an opportunity to get back in. So that's the origin. When you see any videos out there, or you watch any shows telling you that the housing market's crashing because of interest rates, sure, that was a catalyst, and that's part of it. But the real reason is what we discussed before, that the bubble of thousands of homes that were bought on speculation is over. And those homes are now not only not being bought, they're going up for sale. So that's causing an even bigger crisis. Anyway, so enjoy that information. If you liked what I had to say, please subscribe. And for the traders out there, happy trading.